welcome back to another episode of DeFi Decoded. I am Alex Tapscott, here with Andrew Young. Andrew, the conversation that we've had recently has been about the DAT space. First, the buildup of the DAT space, and now we're seeing some of the pressure as the sector becomes somewhat oversaturated and as people sour on that structure. But there's a whole other narrative that's happening in the regulated market, which we used to spend a lot of time on and haven't recently, so I'd like to revisit it. And that's the ETF space. So we talked at length about how IBIT and the other ETFs that cover Bitcoin and ETH or own Bitcoin and ETH had, I think, the biggest debut ever for an ETF in the US market. IBIT reached, $10 billion 10 years faster than it took the gold ETFs and the S&P 500 ETFs, for example. And I think today, actually, IBIT is the largest contributor to revenue for BlackRock from its ETF business, from a single fund. So this is big business. And before BlackRock got into this space, though, there were several other companies that were doing pioneering work. As you know, in Canada, 9 Point Partners, where I used to work, and Purpose and CI and 3IQ were in the Canadian market before the US was open for business with Bitcoin and Ether ETFs. And there was another company that started even earlier called 21shares, which launched in Switzerland and has since expanded into the US market as the market has opened up and as the regulations have become clearer. And we are very fortunate to be joined today by Federico Brokate. Is that how I pronounce it?
Said it fine. Totally fine.
Perfect. Who's the global head of business development at 21shares, where his responsibility is to drive business development globally while maintaining a strong focus on the US expansion. Before joining 21shares, he was director of Americas for iShares business strategy at BlackRock, where he developed and executed growth strategies for more than 400 products, serving over 30 million customers. We're going to give you credit for that massive launch of IBIT that happened in the US. They say luck is the combination of preparation and good timing. So your timing, I think, on that vehicle was good, but it wouldn't have been as successful if there weren't people in the business behind the scenes making it happen. So I wouldn't mind actually touching on that whole experience of yours. But first on 21shares. So 21shares is one of the world's leading cryptocurrency exchange traded product providers and offers one of the largest suites of crypto ETPs to the market. The company was founded to make cryptocurrencies more accessible to investors and to bridge the gap between traditional finance and decentralized finance. 21shares listed the world's first physically backed crypto ETP in 2018, building a 7-year track record of creating crypto ETPs that are listed on some of the biggest, most liquid securities exchanges globally. Backed by a specialized research team, proprietary technology, deep capital markets experience, 21shares delivers innovative, simple, and cost-efficient investment solutions. And I think today, you're over $8 billion in assets, which is a pretty healthy number. So Federico, welcome to the show.
Thank you so much for having me. It's a pleasure to be here. Great intro to 21shares, I have to say myself.
Yeah, thank you. Well, we've been longtime fans and have been watching the business, for many years. And in fact, I would make the case that 9 Point was inspired by the success that 21shares had, especially your focus on expanding beyond Bitcoin, which I want to talk about as well. But first, tell us a little bit about yourself. You came from BlackRock. Before that, were you a crypto degen, or are you more of a TradFi guy who got radicalized later in life?
I am firmly a TradFi guy that got radicalized later in life. Like many people, I heard about Bitcoin early in high school, college days. But eventually, when I graduated from university and joined BlackRock, I started working on the ETF side of the business. And actually, Alex and I were just chatting about this before we started recording, but when the Canadian ETFs for Bitcoin and Ethereum actually originally listed back in 2021, that was kind of this light bulb moment of, oh my gosh, our closest by distance or proximity partner is already allowing access to ETFs that are tracking these vehicles. What needs to happen, what needs to change in order for the US to eventually go down that road?
Yeah.
And that started, a 2-year process between 21 and 23 before we got regulatory approval for listing in Jan 24.
Yeah.
And so I fully got radicalized as part of the launch of the Bitcoin ETFs while I was at BlackRock and joined 21shares, which, as you mentioned, Alex, is the world's first crypto issuer to launch physically backed ETFs.
Yeah. Well, it's interesting. Switzerland is where 21shares got its start, and we were doing cool stuff in Canada before it came to the US. It's almost like these markets are a bit of a staging ground for
Mhm.
what can happen in the U.S. market, which is funny because I think people think of the U.S. capital markets as being probably the most open and sort of open-minded to new issuers, new industries, and so forth. And I think that generally has been true, but at least with crypto, at the beginning, it seemed as if regulators in these sort of tier two markets were more open-minded to begin with. But yeah, let's talk a little bit about the BlackRock experience. So, did you guys think you were going to raise $60 billion, or was that like a complete shock?
No, I mean, look, when I was thinking about the industry as a whole, we did not think that these products would grow at the rate that they did, right? The Bitcoin suite, despite the grayscale outflows, captured over, I want to say, 50 billion in assets almost in the first year, or close there to
Yeah.
another 30 billion this year. So they've been a tremendous success from an asset gathering perspective across the whole complex, right? If you look at all Bitcoin ETFs in the US market today, it's not only IBIT that's captured substantial assets. The majority of ETFs are above $500 million in assets within 2 years of launch. And oftentimes people think, oh, 500 million is not that much, or 2 billion is not that much. In ETF context, usually these products don't actually capture assets until year 2, year 3 down the road. And so what we saw from both the 21 shares products, the BlackRock products, and the rest of our competitors was tremendous adoption.
Yeah, no kidding. And what was the adoption? Was it institutional investors? Was it retail driven? Was it in-kind investors, looking to kind of roll crypto into regulated structures? Like, what was the breakdown for at
Yeah,
least in those early days, and how has that changed at all over time?
Yeah, I mean, it's a great question and something that's actively evolving as we speak.
Yeah,
I think it's been well documented, right? But the initial investors into the Bitcoin products were really retail investors.
yeah,
If you looked at Q1 2024 13F filings, I would say, just to use rough math, 80% of the assets were held by retail, the other 20% by an amalgamation of different sorts of entities. And that has since shifted significantly. I would say about 60% of the assets today are held by retail. That's not because retail is selling, but actually on the contrary, it's because we have all these new types of institutions and organizations coming
yeah,
into the market for the very first time. So the pie, as you call it, is growing substantially for everybody.
yeah.
And what's like the thesis typically for these investors when they come to Bitcoin? Do they see it as, do they see this as a hedge for the fiscal situation, for sovereigns globally? Do they see it as sort of a replacement to gold? Or do they see it as kind of like a risk asset? I'm just kind of curious what typically drives these types of investments.
Yeah, it's a great question, and I would say every single type of client has probably a different answer to that question, right?
Yeah.
I think large part we've seen the comparison to digital gold being a really strong one, and one that fits into modern, let's call it, portfolio theory, and so individuals feel comfortable allocating in that respect. I think another part of the client base is probably just looking at Bitcoin as a good proxy for digital asset markets more broadly, and so they want to include some sort of exposure to the marketplace in their portfolio. And then there's, of course, a smaller tranche, which I would say, or maybe a sizable tranche, that are chasing performance, right? And of course, with any ETF, and that doesn't just apply to crypto, but anytime you have strong performance like we had in Bitcoin over the last 2 years, removing October here for the time being, you're going to have a lot of performance chasing, and the ETFs are a great way to add exposure. So it almost doesn't matter exactly what your thesis is on Bitcoin. The ETFs provide a fantastic long-term vehicle to express that view.
Andrew, do you have another question?
No, yeah, that makes sense. I mean, I'm always curious what drives like the ETF investor versus the spot crypto investor, because it does seem like a very, like if you're someone who's a spot crypto investor, then and particularly if you self custody,
Yep.
then it's a very different type of investor than someone who's investing in Bitcoin but through more institutional focus. So I'm always very curious to hear about that. Yeah, I'm just kind of like, well, I guess thinking about that longer term, do you think has there been any like big shift in the sort of past year in terms of one thesis to another? Or I'm just kind of curious like how, because I feel like when the ETFs first launched, there was a lot of worries that there was going to be any institutional demand at all. Most people sort of thought, at least in the crypto space, they sort of thought of the ETFs as kind of in a lot of ways drawing from like the MicroStrategy investor base, people who couldn't access Bitcoin in a new way. and so they had to buy sort of proxies. But then what's
Yeah.
funny is over the course of the last 12 months, DATs have had their best performance ever. Like they've just completely taken off, and which is, if you had asked most people in crypto, 12, 24 months ago, that's the complete opposite of what most people thought. Most people thought the premiums, the MNAVs, like notwithstanding obviously the last couple of months, a lot of the MNAVs have sort of collapsed. But
Yeah, I think
guess-
they were right though, weren't they? I mean, in a way, like there was a time when these vehicles could raise a lot of capital at a premium and grow like NAV per share. But I don't know. I viewed those as somewhat a victim of their own success in a way. Like there's so many of them, and I think that there's value to a DAT. But if the purpose of the DAT is simply to passively hold an underlying asset which generates no incremental return as a business, the ETF is a superior format for that. Right?
Yeah, I totally agree. I mean, look, I think when we're thinking about the investors in the ETF today, like you mentioned, Andrew, these are long-term investors that are not looking necessarily to trade actively based on what's happening in the market, but rather build a portfolio with an allocation to Bitcoin using the ETF as a primary way to do so. And like you mentioned as well, these ETFs open access to a whole new set of individuals that are not going to custody them, self-custody. They're not going to worry about wallets and keys, and they're actually just going to bake this into their existing processes. And so it really brings on a whole different layer of capital that's now accessible to Bitcoin and to digital asset markets more broadly. The rise and the fall of DATs, I find it very interesting, especially coming from an ETF issuer perspective, where we view the ETF as a better vehicle for most investors, especially in the case where it's just a buy and hold strategy on behalf of the DAT. It's been a crazy 2025 from that perspective, because I think at 21shares we've tracked over 150 different private and public companies that have begun adding either Bitcoin or other digital assets to their balance sheet.
Yeah.
Now, oftentimes, if you're a retail investor, for example, and you don't self-custody, you might view these as an alternative to the ETF. But in reality, because of the premium and discount issue that we all know about, layered on top of the leverage component of a lot of these DATs, you're actually getting suboptimal exposure for the dollar that you're investing in those DATs compared to the ETF. And so what I think we've seen over the last couple of months is a reaffirmation of the ETF as a vehicle of choice for the non-crypto native investors that are looking to add some exposure.
Yeah, it's interesting. Sorry, go ahead, Alex.
No, you go ahead, Andrew.
No, yeah, it is very interesting, because I think like one of the things that I found, for example, like when I tried to buy more than like 2%, I think, of my portfolio on ETFs, Bitcoin ETFs, I was actually prevented. And I think most
What platform?
Yeah.
This is like one of the big 5 banks. Yeah.
In Canada. Okay. Yeah.
Yeah, they don't allow in Canada. They don't allow you to buy more than a couple % of your portfolio.
Wow. That's insane.
But just for Bitcoin ETFs or Ethereum ETFs. But then you can buy as much MicroStrategy as you want, which I always thought was a very bizarre thing.
Yeah.
Because obviously, I mean, in one ways, MicroStrategy is a less pure form of crypto exposure.
Yeah.
There's also like operational risks involved with it, obviously.
Well, more generally, like these platforms should not be dictating what you can buy to begin with. Like you're an adult sovereign person, like you can be able to make decisions for yourself. Actually, I think that's like a good jumping off point, because there was a big piece of news today which has helped to give a boost to the market, which is that Vanguard has opened up its platform. And I believe also Bank of America, through its like advisor retail channel, similarly has opened up its platform. And I wouldn't say that they're like doing so enthusiastically, but I think they're recognizing that, to my point, which is like it's sort of ridiculous to withhold the full suite of investment options to your client base. Eventually you have to give them that choice. What did you make of that news today?
Yeah, look, I think it was a bit of a long time coming, especially in the case of Vanguard and Bank of America in particular. What we've been hearing since the launch of these ETFs is a lot of these wealth intermediaries need to do their due diligence on these products and how they're going to perform in different market cycles. I think that due diligence process, as we can see, is definitely accelerating, and it's almost coming to a conclusion across a lot of these big organizations. Before Bank of America and Vanguard, we saw Schwab, we saw Morgan Stanley, we saw a lot of these big wirehouses and D2C platforms begin to offer access already. And so it's really another, let's call it another domino falling in the right direction here of expanding access to these products across a multitude of different ways that investors can now get access to Bitcoin and to other crypto assets. To build the defense here for the D2C platforms, this is a brand new asset class that had never traded in ETF form in the US before. And a lot of these organizations or institutions operate under fiduciary level standards. And so oftentimes that means lengthy due diligence, lots of phone calls with the issuers, making sure that these products are actually set up the way that they say they are, before they actually allow their clients, let's call them, to begin using their platform to access.
I think that's a good point, because I think probably a lot of people in crypto just assume that this is TradFi resisting the tsunami of crypto and Bitcoin. When actually, to your point, a lot of platforms do due diligence on all sorts of different funds and products that may not be crypto related. And actually, and particularly when it comes to active managers, you usually need like a year or two track record before you're even like considered to be added to the shelf for a lot of banks and wirehouses and so forth. So I think that's a good counter, framing of the issue. But it's also clearly helped the market, right? Like this people are saying, okay, maybe there's this new wave of investor that can now access these are pretty sophisticated sort of long-term investors. Now they can access it. One sort of related point is that in the last little while, we've seen the ETF universe also expand quite significantly in the US, which is really amazing because, the hoopla about the Bitcoin ETF was like months in the making, like, the whole of 2023 all the way up until the approval. And then just in the last few months, we've had 5 names or something like that have been approved. Solana, HBAR, like Litecoin, help me out. There's a couple of others in there. Doge, I think.
Doge.
So what happened? Is this like I'm no longer in the ETF space, so I haven't been following it as closely. But it seems as if people were just using the shutdown as like, if they don't say no, that's the same as them saying yes, and then now they're just out there in the market. Or is there more to the story than that?
No, there's more to the story, and I think it's actually been unfolding in a somewhat, organized manner. So back in August, to start from the beginning, back in August of this year, the SEC worked with the different exchanging venues. So think of NASDAQ, NYSE, and CBOE, and came up with what's called the generic listing standards for crypto ETFs.
Okay.
And so just in simple terms, all this means is they gave the groundwork or the ground rules for what would constitute eligibility in an ETF wrapper for the US market. And so that's what gave way to eligibility for assets like Solana, like XRP, even Doge, based on the benchmarks and the let's call it the process that the SEC established. And so really what it came down to was getting approval on the S1 or the listing application from the issuers for the underlying asset. Now, that process was well underway before the government shut down. And so in October 1st, when the shutdown began, some issuers, ourselves included, were very close to having finalized S1s, right? And these assets were already approved for eligibility in the ETF wrapper. And so in some ways, the shutdown accelerated the approval of some of these assets, but not by more than, let's call it, a week's time. A lot of this was already in flux, and it was actually already happening behind the scenes, if you will, between the issuers, the SEC, and the exchanges.
Okay. That is very, very helpful. And then how would you say the reaction has been in the market to these different vehicles? I feel like people in crypto are totally desensitized by the Bitcoin launch. So they're like, what the hell? Like, Solana didn't raise billions of dollars. But I think the data, like for Sol ETFs, for example, has been really good. Like they've been, I think all but 2 days since they've launched, they've seen net inflows. So there is clearly demand, which is not surprising, but there is clearly demand for these vehicles. And even compared to your point to like other ETFs, I think it's been pretty good. It just hasn't like lived up to those kinds of, I think, unrealistic expectations people had after the success of Bitcoin.
Totally. Look, I think the Bitcoin case study is both a blessing and a curse to the industry because we got accustomed to the greatest ETF launch in US history. And I can't say this certainly, but I would argue probably in world history for ETFs.
Yeah, well, if it's U.S. history, it's probably world
Yeah,
history for
just
ETF.
venture out and say that.
Yeah,
And that's our benchmark now,
yeah,
which is absolutely the curse because, if you look at any other, even in TradFi assets, there's nothing that comes close to the impressive asset raising and speed that we saw in the Bitcoin ETFs.
yeah,
And so, I remember even with Ethereum, people thought the Ethereum ETF launch was not successful, and it raised, I want to say 10 billion in assets this year, which is pretty incredible. That's long-term sticky money sitting in Ethereum.
yeah.
And same thing with Solana. I think we've seen around 2 billion in net flow since the launch of those products, which for any asset, let alone the size of Solana, is a great outcome. The other thing with Solana, Ethereum compared to Bitcoin is it's a smaller market cap. And so you're going to inherently have a smaller percentage of a portfolio allocated to that asset.
Yeah.
At least that's how a lot of TradFi investors think about it. And so you have to scale expectations based on the size of the asset. And that'll, of course, evolve as Solana and Ethereum and all these different networks continue to grow.
So what do you think the future of, like, let's look, a year out, 2-3 years out, what's the future of crypto ETFs look like? What are the things that you're sort of excited about? What products haven't really been explored enough yet? When are we going to get things like staking? Yeah, just kind of let's peek into the future from your perspective.
Yeah, look, I think the future for crypto ETFs is extremely exciting. We're going to see a whole lot of product come to market outside of what's already in the US. In regards to staking, I'll start there. So staking ETFs have already been approved and are already trading. So you can buy Ethereum staked, you can buy Solana staked through the ETF wrapper, which is an incredible outcome here for how short of a time these products have been in market. The other thing I'll say is, at least at 21shares, we're very focused on not only bringing single asset ETFs to market, which we absolutely are doing, but also on what comes next after single asset ETFs. And a big part of that answer, that at least from our perspective, is going to be index and basket solutions.
Yeah.
So think of an S&P 500 type of strategy, but for crypto. And so we launched the first 40x versions of versions of that 40x product in about 3-4 weeks ago. And so I think as we look into the future, we're going to start to see a lot of more single asset ETFs. We're going to start to see aggregations in different strategies, whether it's like only a simple index, like a market cap weighted like ours, even an equal weight. You could start to see the entirety of the ETF landscape kind of coming into the ETF realm now that we have a lot more assets that are eligible for inclusion.
Yeah, well, it's a great point because you said at the outset, Bitcoin is in portfolios for several reasons, but one of them is it's digital gold. It's very well known, right? Those are sort of it's to be overly simplistic. Once you get into the longer tail of crypto assets, people don't really know what they are, to be honest. Like, they maybe know the difference between Bitcoin and Ethereum, but they don't between Ethereum and Solana, let alone all those other ones we talked about. But in a way, that's okay. Like, I don't know. I couldn't name all 30 components of the Dow Jones Index, right? Like, and I don't know what all those companies do, but I know that by owning it, I'm getting exposure to, American business and capitalism pretty much. So it's sort of like with crypto, it's like if you think that digital assets are a big deal and that this technology will be used more widely in finance and maybe other industries, then you should probably have a portfolio approach in the same way that you would want a portfolio of internet stocks in the 90s and not be all in on AOL or something like that. Not to say that Bitcoin is the AOL of our time, but just you want to have some diversification. So I think that makes a lot of sense. So yeah, like when it comes to index funds, do you guys have an index yet? Like,
Yes.
And what's in it? Like, what are your picks?
Yes. Yeah, so far we're going with a very traditional approach. We have two market cap weighted ETFs.
Yeah.
Both track the top 10 of crypto assets. One includes Bitcoin, one excludes Bitcoin. And so it dynamically rebalances every quarter. So as assets grow or fall in terms of their market cap, they will be included or excluded from the product going forward. So at this stage, all the
top
big
10 or top 20? Like
they're both top 10, one with Bitcoin, one without Bitcoin.
So the Bitcoin one, the thing about the Bitcoin one is that you're basically like, it's a lot of Bitcoin beta because it's what, 65 or 70%
Yep.
Bitcoin. And then ETH is 15%. So it's heavily weighted to the top two. the second one would be much more balanced because Ethereum would be the biggest holding by far, but there are lots of other big names out there, right? So
Lots of big names. And actually, if I think about it, I'm really excited about the one that excludes Bitcoin because if you're already a Bitcoin investor, this is the perfect complement to filling out your digital asset portfolio.
So if I like pull it up, it'll have like Solana, BNB, XRP, like all the actual biggest by market value are
All
just
the
the
biggest by
market
market
weighted
value.
X Bitcoin.
Yeah,
That's a
right.
that's a good product. Like that, it's like okay, I own Bitcoin. What else should I own? Rather than I should go be picking stocks, which is effectively what picking single asset ETFs is. It's like here's
Yeah.
the rest in a sort of more managed format. Do you guys do any active management, Federico?
So we have done some in-house, and actually one of the things that we're really excited about is an active ETF that we're launching in the US at some point here over the next couple of months.
An active crypto ETF?
Active crypto ETF, correct. Yeah, can't say too much about it because we're currently under the quiet period for that
Yeah.
product, but that is under works.
Cool.
Yeah, it's been interesting that there's not really. I guess like one of the things also that we could see with crypto is sort of like one of the big things in ETF world is you have like factor based ETFs, like value based ETFs, momentum based sort of ETFs. I'm curious if we're ever going to get sort of maybe that's like the next sort of round after this is we start to get like exactly what you're talking about, more active management. I mean, I'm assuming initially the first actively managed ETFs will be, mostly discretionary based, but there's a whole design space that you can kind of do if you sort of treat crypto assets as kind of not equity, but sort of like hybrid equity type assets.
Absolutely. And you can layer a lot of these, let's call it built up expertise from TradFi into the crypto product development side. And like you mentioned, Andrew, it's, there's a whole set of factors that we could begin to develop products around, or even analyze existing performance through that lens, right? You could look at an active discretionary portfolio or ETF and look at what are the different factors that are driving the outcomes for that portfolio. So all that analysis, we'll certainly be doing it for our product whenever it comes out. And we're really excited because it's our first chance to provide clients with our in-house expertise that's built on our 7 years in the market around research.
What do you think about the market generally right now? I mean, I think like we've talked a lot on this show about how sort of bizarre this market cycle has been, in the sense that Bitcoin's done very well, and Ethereum's done okay, Solana's done okay, kind of, and then there was some pockets of outperformance with like AI agents, maybe some meme coins for a little bit, but for the most part, everything's down pretty massively. And it's kind of like it's a weird bifurcated market where Bitcoin's done very well and everything else is done pretty poorly. So yeah, I'm just kind of curious, like, what's your take on this? What people call like the most disappointing crypto cycle yet, and also just like where do you think we are in this cycle? Do you subscribe to like the 4-year cycle? Do you think we got more to go? Yeah, just
I am perhaps unpopularly, I do not believe in the 4-year cycle anymore. I think that the client. Huh?
I said that's good actually because the 4 years are up. So
yeah, I don't believe in the 4-year cycle. I think the dynamics behind Bitcoin in particular are just completely different from what they used to be. In large part because the client base looks different, right? Like you're bringing in sticky long-term capital, whether it's through DATs, whether it's through ETFs, whether it's through just corporations or foundations or pensions buying direct. Like these are all new avenues of capital that are coming in that have very different behaviors from what historically drove Bitcoin and crypto prices more broadly. So at least like on the 4-year cycle, that's my perspective. I also think that crypto has kind of another blessing and curse, which is the mark to market and the daily liquidity and the daily reset of its value of every single token. If I think about crypto, it's much more akin to a VC style investment where you have to think 3, 5, even 10 years in advance in some cases for some of these projects. But the reality is that their tokens are marked to market every single second of every single day. And so you're able to layer into a VC style long-term investment all the incoming macroeconomic data and even like project specific data, which could cause disruption or let's call it downward movements like what we've seen outside of Bitcoin over the last couple of years. Now that said, I think a lot of these projects just need to be given time to grow into their, let's call it quote unquote valuations. And that's ultimately what's going to drive growth for the entire industry. Is like, what are the use cases that people are actually flocking to and using, and how do you grow into those revenue profiles that your token price might indicate that you're worth.
Yeah. Interesting. A related point to that is most VC-backed companies never see the light of day. They never become listed. They never become public.
Right.
Whereas like every half-baked idea or not baked idea has a token. So there's just this problem of there's not enough risk capital for so many risky assets, as you pointed out. Like there's just too many tokens out there. And that's why I think
And
that
that's a
probably
blessing too, right? Like that's not a bad thing.
it is a good thing. I'm not saying it's bad overall, but like that one of the upshots of all of it is that you have a mass market that's not particularly educated and they're spreading their bets too thin. But I also think that the cliche, but it's a good one, which is that the market is a voting machine short-term, a weighing machine long-term, that the ones that do have value will rise to the top. And I actually think that crypto will probably follow a similar power law to tech in general, the Mag 7, or there's probably 10 or 15 like really big mega cap tech companies that have kind of accumulated or captured a lot of the value from sort of the internet era and the first digital age. And so we're on the brink of this sort of new era, and it's possible that Bitcoin has already done that. It's already at 2 trillion. That there will be maybe 5 to 10 others that see similar kind of power law dynamics, but it may not be the 10 biggest that exists today. So what's interesting, your index is an interesting kind of concept because if one of those names slips out of the top 10, well, you will rebalance to consider the new one, right? So in a way, like you're adapting. It's a lagging indicator, but it's still a good way of doing it, of like adapting to what may be emerging versus what may be declining. And I think that's also really interesting. In the time we have left, I want to go back to the whole DAT space. So I think like the people looking from the outside in, I think might naively think that DATs are bad for ETFs. But what happened during the first part of this year is that they actually helped the ETFs. Like the launch of, like we looked at the data, it's like if you look at SharpLink and the Ether machine and these other DATs that launched for ETH in particular, the ETH flows into the ETF way outpaced, after the DATs launched, we saw more flows into the Ether ETFs than we saw prior to the launch of the DATs, because they had helped to sort of expand the market. The price had gone up, which price is a leading indicator, everyone piles in afterwards. So like in a way that they were sort of helpful for ETFs, for flows. I'm not sure if was an experience that was shared widely across all crypto assets, but I know it was true for Ethereum and I think for Bitcoin too. But now the tide has come out on the DAT space. And I don't think it's a rise and fall. Like I think DATs need to find a new level and figure out what they want to be when they grow up. And maybe some of them shouldn't exist because there's too many of them. Like I think there's probably something to be said there. But how is the tide going out impacted the ETF flows? Do you think that the DATs are impacting your business currently?
It's a great question, and I think there's a bit of correlation versus causation going on there between the rise of the ETH DATs and the ETF inflows.
Probably.
I don't think they're as strongly there's not as much causation in my perspective. I think a lot more of it was just good timing for the Genius Act, for example, which passed in the summer and gave a clear carte blanche for stablecoin companies to continue to grow and to continue to evangelize their product, which obviously is a fantastic boost to Ethereum, right? And so I would argue that had a bigger effect on ETH ETF flows and the DATs. Now that said, look, the DATs in some ways compete with ETFs because they take client flows, right? And so there was this moment in the U.S. market where there was a bit of a, let's call it a regulatory arbitrage that you could do by launching the DAT because the ETF wasn't approved. And so you were able to get access to different types of cryptocurrencies through a DAT, but you weren't able to do so through an ETF. That's all changed. Like I mentioned earlier, there's going to be a whole lot of product proliferation in the crypto ETF space going forward. And so I think it's more so clients finally have the tools in the ETF form to get exposure. And it's not so much that the DATs are either giving way or giving rise to help boost ETF flows, if you will. Now that said, bringing capital into crypto broadly, whether it's through a DAT or through an ETF, is great for the crypto space. And so what we're proponents of is clients understanding the differences between the DATs and the ETFs and being able to manage their risk accordingly.
Yeah, love it. So you're head of global business development, but the U.S. has been kind of like the main show. But like, what else is going on in the rest of the world? Can you give us sort of an overview of what else you're looking at? Other markets opening up to this stuff? Is it really still all about the States? Like, tell us about the global picture.
Yeah, no, look, it's a rapidly evolving global landscape, and there's a lot of markets, particularly in APAC, the Middle East and Latin America, that are looking to seriously expand access to crypto ETFs. A lot of these markets already are very heavy users of crypto, and they're already heavy users of the, let's call it the D2C or the direct platforms of crypto exchanges. But I think given the U.S. experience, regulators across the world are seeing the benefits of having a regulated vehicle that their investors can use to create access or to create exposure to these assets. And so we're heavily looking at markets like Brazil, like South Korea, like Saudi Arabia, which have very forward-looking legislations being proposed in a lot of cases, and have a very crypto-native client base that could benefit from having regulated exposure in these types of vehicles.
And so, do you see 21shares and BlackRock and Fidelity and everyone basically like doing like mirror listings of what they already have, or would you be standing up and launching whole new products in those markets?
Yeah, look, I think our approach has always been to be very, very collaborative with regulators, both in the U.S. and abroad. And so, in some cases, like Brazil, we actually cross-list our existing ETFs, where it's easier from a regulatory perspective, and it's quicker in terms of time to market. In other jurisdictions, there's a preference for local vehicles, and so we'll do that in those markets as well. But I think our approach has been pretty flexible, where our interest is just bringing the asset in the regulated vehicle to whatever market it is, and working with regulators to do that.
Yeah, very cool. Well, that sounds like you've got a lot on your plate.
Really never a dull moment.
Exciting. Well, it's an exciting time. And 21shares has been a pioneer in starting before most, but has continued to be a leader as the market has become a lot more competitive, which is a hard thing to do, to be honest. Like, when BlackRock comes to the table, you better be ready. And 21shares has done a good job of remaining innovative and doing really interesting stuff. So congrats. Great to chat with you, Federico. That was a really great episode. That's really this is my kind of cup of tea. So I've really enjoyed this conversation. That's it for this week's episode of DeFi Decoded. I'm Alex Tapscott here with Andrew Young. Thanks for joining. Make sure to to comment, or to share the podcast. Helps other people find it wherever you listen or view it. Until next time, have a good one. Take care.
Thank you.